Hello, this is Mike Swanson of Wall Street Window. I got a very special guest. I'm speaking with David Skarica, who runs the website addictedtoprofits.net. How you doing today, Dave?
Good. Thanks for having me, Mike.
Well, it's been a while since we've done a video interview like this, and we thought we'd do a video instead of just audio so we could show people charts and so forth. So I'll get right at it. I'm going to pull up the chart of the Dow, which has got everyone's attention, and it's been going like straight up all year. Of course, after the Trump election, you see it? Is it coming up? There it is. There, yeah. So anyway, it's been going straight up. I've had a pullback. The S&P 500 hasn't even gone down 1% in a single day in like 90 days in a row, which is, I think, a record. What do you think is going on? Do you think this is going to continue for the rest of the year, and we can just sit here and get in and get rich? You know.
I actually look as a disclaimer to show you how much I knew. It's that when the market was trading like this in 2013-14, I kind of turned bearish in the middle of 2014 or so, like the late spring, and the reason was it was just like now the market was going straight up with no pullbacks. It was very overvalued. All these investors' intelligence and all these surveys were showing way too much bullishness. Now, I'm not going to say I was right and try to, but in fairness to myself, for the next 2.5 years, really till the end of last year, the market did nothing. The market basically was in between this big trading range of 1900 and 2100 for 2.5 years. So to me, that's the best case scenario right now, with it so overbought, so overvalued, and so much enthusiasm in the market. Either we're going to have another 2-year period like that, and then it goes up again, or more probable, in my opinion, we're going to have a bad bear market. And another factor right now, which I'll show in a second, is I think that right now we're the polar opposite of where we were in 2009. And if you remember, 2009 is similar in that Obama just got elected. You know, after 8 years of Republicans, we had a new guy from a new party get elected, right? So Obama just got elected, okay, and then but at that time it was the opposite in terms of the market. We just had the financial crisis. The market was in an 18-month bear market, and people thought that it was going to keep going down forever. So then the first 3 months of 2009, the first 3 months of his presidency, the market went straight down, which I'm going to show you in a second. The S&P actually, from the beginning of January of 2009 to I'm going to get a weekly chart just to show you this, to the end of March of 2009, essentially went down every single week. There was only one up week in that period. I'm going to show you this right now. Yeah. Let's go back in Hangouts and just get this. So you can see my screen here. That's just a picture of you because I'm on the Hangouts. But you can see this chart, right, Mike?
Yeah, I see it there.
Yeah, okay. So you can see here that okay, you can see the financial crisis in 2008. The S&P drops off a cliff. It goes from 1,300 to 800, and then has a little bounce in late 2008. And then essentially, if you count here, 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. So basically the first week of March, and that would now only be 2 weeks away. The market was only up one of those 9 weeks. And right now we've had 7 straight up weeks since the beginning of the year. So again, I tell people, if you want to think I think is going to happen, is you take what happened in 2009 when everyone was negative, everyone thought that the market was going to keep going down forever, it went straight down to start the year, a new president, et cetera, is, you turn that upside down, and now we're going straight up, and everyone thinks that, Trump's going to cut taxes and bring business back and do infrastructure spending, and we're going to have a huge boom, and again, the other similarity on the opposite end is back then we were nearing the end of a bust. Now we're kind of nearing the end of a nearly 8-year bull market. So we're kind of seeing the polar opposite. in kind of psychology and where you are in the market cycle and the economic cycle. So I hate to be so negative, but this is kind of what I think. And like, I don't usually get into politics, but if we go like politically, what's going on, there's all this turmoil, right? Flynn already got fired. I think there's infighting within Trump's cabinet or, the people that are surrounding him. And then obviously I think people inside the government are doing some things because they're entrenched in these bureaucracies and the power, and Trump is trying to take kind of that away from them, because he's like an outsider, you could say, and they're kind of leaking things. So you've got all this turmoil, and at some point, I think that turmoil is going to spill over into the stock markets and the economy. I don't think you can have this extreme political turmoil without this extreme economic and market turmoil following. And I think the central banks have done a great job of hiding that. We've had the Brexit vote, we've had Trump win. It looks like the populist guy in Holland is going to win. It looks like Le Pen has a good chance of winning, or at least going to the runoff in France. If they have an election in Italy, 3 of the top 4 parties, which represent over 50% of the vote, are anti-Europe. So I think at some point, all this political uncertainty, so it's not just United States, it's not just pointing the finger at Trump. This is happening all over the world. This political uncertainty and this rise of populism globally is going to affect the markets at some point. I don't think the central banks can keep papering it over.
Well, your chart there, I remember the first quarter 2009, 2009, because I was fortunate enough to, I shorted, I was short during the crash and I got out, but then I just stayed in cash in the first quarter, and I saw it go down and everything was so negative, and the move, I got myself, I didn't adjust fast enough. I didn't get bullish or go long until June. So I didn't get in on the bottom, and I missed that rebound. And I was actually trying to short a couple times and got out real fast, but that wasn't a big deal. But the point is that when you're in a trend that is so dramatic, and when you get to the end of it, it feels like it's never going to end. And that's how it felt then, and then it did end. And we both learned from that. And like you say, now it feels like the opposite. I mean, I don't see signs it's going to end tomorrow. But I think if I went back to January 2009 and told myself, I got to watch this real closely for when it's going to turn around and go up, I would have been a lot better off. And I think I'm learning that lesson today, or applying it today, by telling myself, I don't see a sign that it's topped yet, but man, we got to be on guard and not just miss it, and be complacent, and because it's like a true echo chamber where everyone is really bullish. Even the Richard Schiller, who made the CAPE ratio, which says that the stock market is overvalued. We've mentioned him over the years, and he's done interviews over the past couple of years. We'll say things like, this doesn't predict the future, but it means it's overvalued. I don't know what's going to happen. I see him now doing interviews where he says it's going to go up. So he's even bullish, him.
He's saying that the CAPE might go to 45 like it did in 2000.
Oh, really? That's what he's saying?
Yeah, I've seen him say that it might, because Trump will bring being rich back into fashion, right? You don't have to be frugal, because Trump himself is a billionaire that's got gold-plated, private planes, and he's saying that. But to me, I'm very wary of that, because it's like that was a once-in-a-lifetime bubble, and to think that we're going to go back to that kind of valuation, and other than 1929 and the present, that's the only time period we've ever been more valued than now, or 1929 on the CAPE ratio. So to say that that's going to happen is very risky. And I just updated the chart to show you now what's happening. And again, notice the polar opposite, that we've gone straight up since the start of the year. And I'm not going to say it's going to be exactly the opposite of 2009, but if this were to be the case, we would go up for another 2 weeks into that first week of March, and then actually start to top out, just like we bottomed out there. Now, I don't know if that's going to be the case, but I just think the way that it's blowing off is very similar, in terms of the exact opposite of the way it bottomed in 2009, is that you were at the end of a trend and then you had this last kind of surge higher. And look at one thing about 2009, if you go look at that bottom, which I just showed earlier, the volume on the rally over the second half of March of 2009 was bigger than the sell-off, right? So it was really bullish. Well, you can see here, these volumes are really pitiful, right? We did have a nice volume jump the week of the election, but after that, these volumes have been pretty low. You can see all these weeks here in October, November, December had much higher volume. So we're not seeing this. We're actually seeing like a no volume, no volatility rally, not some huge breakout on great volume or something.
Well, that's a run that happened in 2011.
Yeah. It's like, other than really the week and the week after the election, the volume has not been really that great. And it's just like a lot of this has been caused by short selling. Like, for example, I don't know if you've ever heard of a company called Fairfax, but they're kind of like the Berkshire Hathaway of Canada. And this guy's become very famous and very successful. And he recently said that, but it's unlike for Berkshire, he's kind of more like Carl Icahn in that he'll go long short. So he had a large short position on like Carl Icahn last year. And he said that after the election till the present, he covered all his shorts. Now he's actually talking about the market going much higher, this Fairfax company. So what I'm saying too is a lot of this volume, which is still anemic, is probably just due to short covering, because there was quite a bit of amount of shorting going on in 2015 and 16. So there still seems to be no real active participation, in the markets.
Now, all this said, though, myself, I'm long stocks. I'm long stocks, the U.S. stock market, but I'm watching very carefully to hedge or do some selling or whatever. But I'm also long gold and gold stocks. And last year, you are too. You're bullish on gold and gold stocks. So, I can't really tell people go jump in the stock market now, even though I do have positions and everything we say concerns me greatly. But I just want to say there's people I know who may get discouraged from us. They may think, you're telling me I can't make money now. But we're actually not, because we both are very bullish, or at least in the long run. I'm not sure what you think about the short term, about gold and gold stocks. Last year, the GDX gold stock ETF, which I do own, was up 50%. This year, it's up 18% year to date. That's beating just about anything in the stock market totally. So there's a lot of money to be made, and I think these things they don't really trade with the market necessarily. So the overvaluation in the stock market doesn't bother me when it comes to gold and gold stock.
If we look at the gold and gold stocks, it's much more similar right now to 15 years ago than 10 years ago. And what I mean is it's much more similar to 2000, 2001, 2002, when the gold stocks were coming out of a big bear market and going higher as the market was going lower, as kind of like a safety play. Whereas in 2007, the gold stocks went up with the market the entire time in that bull market, then fell with the market. So I'm not too worried about the gold stocks falling if there's a big bear market. Now, in the bouts of intense selling, they may get taken down for a few days or a few weeks, right? But the thing is, again, the stock market is really disconnected from the gold and precious metal equities right now. So it's more like the early 2000s than the mid 2000s, which means essentially that the gold stocks, if we did say top out shortly, the gold stocks could, probably rally as the market goes lower. And what's interesting is gold has actually acted quite well and held up quite well, even as the stock market has gone higher, which is kind of different from 2013, 2014, when essentially gold was acting poorly as the market was breaking up to new all-time highs. So I kind of see that as a positive too, that gold is holding up and acting, much better than the rest of the market. But if we go look at anything, you go look at something called the RIDEX ratio, which shows what people are doing with their money, or you look at investors' intelligence and all of these things, everything is showing an extreme blow off in sentiment in the stock market. So, okay, maybe you think I'm a doom and gloomer or a perma bear, but the last time we saw this sort of thing was like, 2014, right here. You can see the S&P is about 2000. And really the S&P, like I said, did nothing for 2 years after that, into the middle of 2016. So my opinion would be the best case scenario is we're going to have another period like mid 2014 to mid 2016 now, or we're going to really, really dump like 07, 08. So is it really worth it right now to be long equities, hoping that the S&P will go to 2,500 or something, or even 26, 2,700? It's not worth, my opinion, the risk reward for 10 or 15% risk when the downside is probably, 50%. And the one thing about the CAPE ratio, it's really interesting, and I'm going to go way back to the late 90s to show you, is that the CAPE ratio started going way crazy in 97, 98. So let's say back then you got 98 or something, or not, you got scared and you just said, well, the hell with this. I'm selling, stocks are overvalued. The S&P is sitting here at 1,100 or something, 1,200. Well, okay, it went to 1,500, but ultimately you got to buy it at 800. So even then, if you had patiently saw that the market was overvalued and waited for years and years and years for a better buying point, you escaped all the carnage and losses, and then you also got to buy at a cheaper level ultimately.
Well, the thing about that makes that better, back then, gold was in a bear market. So that wasn't an alternative. You couldn't have taken money out of stocks and made money in gold at 98, 99. But now you can.
Well, even in 99, if you had been patient, the gold stocks bottomed a year later. So, like, again, in 99, if you say, sold the S&P at 1,200, look, let me show you. I'll put the HUI chart up. So even then, I think gold's acting better now than then. That's the good thing. That's what you're just saying. But even then, if you bought the HUI here, I don't know, at like 70, okay, it had one more leg down, but the HUI then doubled by 2002, and the market had gone down 30 to 40% by that time. So so still even then, but I think, like you just said, the more positive thing now is it looks like the gold stocks have already bottomed. They bottomed early last year and are starting a new uptrend. So you can buy them and they'll probably move higher. Like if they're able to hold up here and go higher as the market is breaking up to all-time highs, well, that bodes really well for when the market starts to break down and there's, a flight to safety into gold and precious metal stocks.
Well, right now, what are you doing primarily to profit in the financial markets?
Well, what I do is I have some small hedge positions and short positions, and I'm doing something kind of more unique in that I'm the two things actually kind of unique. I buy these really beaten up companies, right? So let me give you an example of one. This happened to be a resource stock, and not all of them are resource stocks, by the way. I do have ones that are actually two of them that I think that own just one's a healthcare stock and one is a tech stock. So this is a company, and obviously I don't recommend buying it here because it's just had a big run, but this is a company called Black Iron, and this company has an iron ore property in Ukraine and also interest in a gold property in Romania. So what happened was I was just picking away at this stock in our newsletter at 3-4 cents, and the reason being is this company is well-funded. They were actually doing a stock buyback, a proper stock buyback, not buying back at all-time highs, but buying the stock at 3-4 cents after it was really beaten up, right? So I was like, well, that buyback is going to keep the stock, support level under the stock. At some point, when commodity prices go up again, they're going to put this iron ore property into production. And so I'm like, well, at 3 to 5 cents, where's the downside? Let me average down in here, and you can see, boom, they announced that they're going to start, have plans to put this iron ore property in Ukraine back into production. You see the stock goes from 3-4 cents to 11-12 cents. So this is essentially the thesis. Just buy something that's beaten up, cheap, has very limited downside. Maybe for a year or two it does nothing, but when it breaks out, it can do really well. Like another example, and this is stock I actually sold a little too early, just so you know. This is Mekhl Steel. This is a steel company in Russia. And you can see the same thing. I started buying this back in 2014, I think around $3 a share. And it actually went even to $1.50, but now it's $6 a share. I sold a little too early. I think I sold at the equivalent of 4 or something like that. But you can see, even at 3, if you could average down even more, but whatever, I still would have almost doubled my money now in a few years, right? So what I'm saying is this is the kind of stuff I like to buy, stuff that's really beaten up and may take a year or two to play out. Sometimes you're lucky and it plays out quicker, right? But that's the kind of stuff I'm buying. And then I'm also buying these little precious metal deals. Like one thing that like both of us actually are looking for is what I like is near production deals. So I find that, I've been around precious metals market for almost 20 years now. And what I find in the new bull markets, what does the best are companies that have small producing mines and then that are able to increase the ounces produced as the price of gold goes up, and the ounces they have in the ground get worth more too. So we're talking, they may look like penny stocks now, but these are stocks that can really, really move up. And this may sound crazy, but thousands of percent. Like one stock that we were introduced to in the early 2000s was Desert Sun Mining at 25 cents. And this stock ultimately went to $5 or $6 a share, and the company was taken over by Yamana.
It went to $9. It went to $9.
It went to $9. Yeah. Another company was Avion Resources, which had a producing mine in Africa, and in perfect timing, it was actually an old mine that Nevsun used to own. But they started production on their end of it in early 2009. This stock went from 6 cents to $2. And these are the kind of companies I'm looking for. So right now I'm actually doing a private placement in one that's an earlier private placement in the company. The company should start trading, but the management actually has a history of taking companies public and getting them taken over. Actually, the chairman of the company is actually the chairman, let me show you this, of a company called Dynacor. And Dynacor is kind of a company that does processing of minerals, and also does its own production. That's a shorter term chart. But here's the amazing thing. This is why I really like this deal. Dynacor's in Peru, and this company's doing the same thing in Colombia, right? So you can see that Dynacor back in 2009, 2010 was a 20-cent company, and it went to over $2 at a time when there was a gigantic bear market. The average gold stock went down 80%. This company went up tenfold. So this little private placement I'm doing has basically the same model as Dynacor. The only difference is they're in Colombia instead of Peru. So these are the kind of things I'm buying. And look, to be honest with you, this is not something counting my chest or something, but I actually have access to these kind of things, like where maybe the average investor does not. Now you have to be accredited, to buy a private placement in something like this, but these are the kind of things I'm looking at right now. So I'm looking at things that are beaten up, near production gold plays, and then I have a hedge short position. And actually what I'm doing is I'm kind of just adding to the hedge short position every week or two, just averaging down, figuring that, it's almost like dollar cost averaging, like someone would do on the downside. That's like, this is a bubble. I can't time the top of it. And by the way, have you ever seen the movie The Big Short? When those guys in the middle of the movie get totally fed up because the trade is going against them. They don't know when this bubble is ever going to end, and blah, blah, blah. That's the way I've become shorting, that I'm just like, well, I know it's going to work out at some point, but right now it's just trying to nightmare. It is a nightmare trying to short this, So just average some shorts. I have individual companies we short in the newsletter. If you're a more basic company, we've got ETFs you can buy to short sectors of the market as a whole. And then that you're just basically, you're hedging at that point. And the idea behind that would be you own these beaten up companies. If there's a big crash, that might even take down some of these beaten up companies down in the market. But then these shorts will go up and hopefully you'll make a little bit of money. And also, I also buy put options as kind of a more leveraged short play as well. You know,
You mentioned a company you did a private. I actually bought it too a couple of days ago. So I took advantage of that, and I think anyone who wants more information about that, we're going to do a special offer for them to get into your private premium trading service. And if because you're sending this out to your pay members, not to everyone in the world, and they also will get other trade updates and other stocks that you own that they can just buy normally right off the market. But I think we're making this. We talked about doing this offer because of this private placement opportunity that's now available, and it's going to go away fairly soon. So if you want, could you tell people more about what you offer in your trading service?
Yeah, so like I mentioned that we were shorting. So I have a short list. I have a trading portfolio, and we have a long-term portfolio where like Black Iron would be a company that's on the long-term portfolio, because I was just buying that and hoping that and thinking that it would turn around at some point. So we do all that sort of thing. And then another thing that I'm doing that's unique to this year, because I found 3 or 4 companies that I think was either way, right? Mm-hmm. So you know what? I will give away one, because I'm just going to give away the company, but I won't give away how we're going to profit from it. Wynn is this casino company, as you know, right? And Wynn is, you can see in this trading range, I'll get a shorter term chart. Let's get a 2-year chart. Since about a year ago, February, March of last year, about March, so about 11 months now, of between roughly $85 a share and $105 a share. So it's going to break big out of this range either way. So what I'm going to do in Wynn is we're going to buy some calls and we're going to buy some puts. And our idea would be, if Wynn breaks down to its lows at 50s, the puts are going to go unbelievably high. You'll lose your money in the calls, but you're still going to make so much of the puts. Like, you'll probably make 5 or 10 times. So even if you lose in the call position, that means you make 2.5 to 5 times your money. Or if Wynn breaks out and goes to 150, you're going to make money on the calls. So this is kind of the idea. And look at Wynn had this range in late 2015. Between 50 and 70, and that would have worked then if you would have bought the puts thinking, okay, Wynn could collapse to $10 a share, and you would have bought the calls thinking Wynn could rally back to 100. Those calls would have made an unbelievable amount of money, and you wouldn't have to worry about the puts going to zero. So we're doing trades like this, and we got about 3 companies right now. I'm going to look for another 2 or 3 to do them on, and the idea is either these companies are going to have huge moves, like they're going to go up 50% or down 50%. And that kind of movement in the option market, as long as you're like straddled or kind of hedged, you're going to have a big profit either way. And the real big profit would be if there is some kind of stock market meltdown, because then you'll see the premiums absolutely rocket in your put options. And you won't even care about losing money in the calls. Now, some companies, I'm just going naked short in the calls, in the puts, and that they're very overvalued, and I've just got interest in buying puts on them. But we're going to have a bunch of companies like this. If you're someone who kind of wants to play both sides of it, where you're going to need a big move, okay? Like if Wynn stays in that range for another year, but if I'm right, and I doubt that Wynn is going to, have an 18-month trading range, So it's probably within the next 6 months, you're going to have a huge move in either direction and Wynn, and that will make you a lot of money. So what I'm doing is I'm only buying January 2018. I'm not going to buy any short-term puts in this. I'm just going to buy 10 months out, and then hopefully if you get a big move in each direction, it does really well. So it's a way to hedge yourself and a way to make money in either direction. Like, for example, last year I had puts on Deutsche Bank, right? And I sold my puts, luckily, before Deutsche Bank had a big spike. But that would have been a great company to do this trade on. So the company was going between 12 and 14. Either Deutsche Bank was going to blow up and go to zero and be a Lehman Brothers, or it was going to have a nice rally back to 20. So you're going to get the stock going down 12 points or going up 8 or 10 points. So, so calls or puts or this kind of strategy would work. So that's really what we're looking for. So I think that's unique because I don't think many newsletters do that kind of strategy. So, and then like you can combine all this. You buy some stocks that are cheap and beat up. Like I showed you Black Iron. You can buy like a straddle type strategy with these options. And then you can also just short overvalued stocks to hedge yourself as well. So I think I really try to do a well-balanced kind of portfolio. And I still have a large short position. What's funny is that, since January of 2016, my portfolio is probably up 30 or 40%. And I could show you one portfolio to prove this. But, but the thing is, I've done that while keeping a short position. The short position is done poorly, but I'd rather keep that short position because I'm so scared of the frothy, valuations on the market.
Would you mind showing it? It might be interesting to see it.
Well, sorry, would I buy what? Sorry.
Oh, would you want to show people that portfolio or?
1 second. Yeah, let me take this off. It's a trade for a family member, so I don't want to show people the account. So once again, let me log out of this, and then I'll show the account. Okay. I got no problem doing this. So.
Well, I kind of think in my back of my head that it shows people this is all real. What we're talking about, it's not just
exactly. And just so you know, this portfolio specifically only uses equities. So if you're someone scared of options, this just shows you how maybe you can do it and not have to, 1 second. Yeah, here it is right here. Just gonna get it here. Then we're going to show you this. So I'm just trying to show it without the account number and all that sort of thing. Yeah, perfect. This is perfect. And look we're market-wise speaking, both of us are pretty young. So we kind of both learn still, right? So when I really learned how to hedge properly and have a well-balanced portfolio, this is when I've really started doing stuff like this. So this is the portfolio you can see here. So this is from 13th of January, 2016 to 17th of February now. So it's basically 13 months. You can see it says right here, it's up 48%. The annualized return is 42%. And, actually at one point, this was actually up 80%. But what happened is this portfolio has some gold stocks. So when the gold stocks pulled back, you can see the chart, it came back. But then I've had this strong rally recently. And the only thing I regret with this portfolio, and 2020 it's hindsight, makes you a genius, but was that I just didn't dump everything in the middle of last year and just wait again to buy. But, that's not realistic. But you can see, but this has been basically with keeping, for the most part, a 20 to 30% short, a short position. So you can see here the TSE, is up. This TSE S&P comp's up 28%, and the S&P is up 11% in the same period. So it's done way better, than that,
Well, it says you got an annual target of 2.2%. Well, we can safely say you smashed.
I don't know how they come up with that. I would like to make a little more than 2.2%, I would think, but
oh, you did, that's for sure.
Yeah, 2.2%. You might as well buy that crappy 10-year bond.
No.
So it's just like, and look at this is what I'm saying is, actually it's funny because Stan Druckenmiller, the famous hedge fund manager, he said he likes to hire guys that are, I'm not saying we're as good as some top hedge fund guys, but he says he likes to hire guys that are like our age, or because by your late 30s and early 40s, you've kind of developed like like you've lost money in the market, you've made money, you've got experience, you know how to manage risk, but you're still kind of young and energetic and can really put all the work in. So he was saying that's the perfect age he likes to hire, because by your late 30s, early 40s, you've probably got 15 to 20 years experience in the markets. You've learned from your mistakes, et cetera, and you're still really motivated to want to do these things, right? So, I think that's kind of where this is played in now.
It's kind of like the Jim Rogers story, if I remember correctly, that he didn't really start making money until he was in his 40s in the markets. But,
no, he did it with Soros. He was actually in his 30s because he retired.
Okay.
But when he was 37, remember, he wasn't a manager. He was just an analyst for sure. But if you look at Soros, he's a perfect example of that. Yeah. Soros is about 86 or 87 right now. So that quantum fund really took off in the 70s. It's 50 years ago. Yeah, Soros was in his late 30s, early 40s when he really took off. You look at John Templeton, same thing. He really started to make money in the 60s and 70s. And Templeton died about 8 years ago, and he was 95 when he died. So you do the basic math on that. He was really in his 40s and 50s when he started to make a lot of money. And actually, Warren Buffett would kind of be the same way. A lot of these guys actually didn't make a huge amount of money. They weren't the guys who, were like Kyle Bass made money really young. And even him, though, he was 37 or 38 when he made that big short trade on the subprime stuff. So, yeah, that kind of seems to be the age. Most of these guys, when you're young, you kind of tend to be dumb. So usually when someone makes a lot of money quick in their 20s, they tend to piss it all away or get aggressive or lose money, and then it's really by their 30s or 40s that they start making a lot of money, in terms like on a consistent kind of basis. I think it's just making mistakes. You need time to make mistakes and learn from them. I've made plenty of them. And I think one reason I'm so conservative now when it comes to the stock market and the valuations is I owned gold stocks in 2008 and I got burned. My first learning lesson was in the mid 90s. I owned junior stocks and I got taken down when Bre-X came down. So now I'm very apprehensive about chasing a bubble. I'd rather just be hedged, buy value stocks. And actually another way I hedge, by the way, too, is I bought another IPO that's supposed to be coming out in the next few weeks or month or so. That is a tech IPO. So my idea was, well, if the market doesn't collapse and it keeps going higher, I got this tech IPO, right? So that's kind of the way, but I was like, if it does collapse, I'll make so much money. I don't care if that tech IPO ever comes out. So that's kind of the way you can hedge as well, right? So, because look, we have these idiots who write us, and there are idiots. Oh, you're wrong. You've been bearish on the markets, blah, blah, blah. You're idiots, but really, after a while, all you really care about is hedging and being able to make good money when there's a big move at the inflection point, but also not losing your ass if you're wrong,
That's right.
Yeah.
Well, and it's going to, the other similarity between now, we were comparing this to 2009 is the opposite, but another similarity would be gold in 2011, because that's when it topped out, silver prices doubled. And you and Jordan also warned people about this, and it was like a similar type of situation as now, where that market was topping out. And
I'll show a chart of this for a second, so people know what you're talking about. So there's a guy named Jordan Royburn, who's a friend of ours, and he calls himself Trendsman. Okay, and Trendsman. He's kind of like a gold. He writes a website called and a newsletter called the Daily Gold, right? So if we go look at what Trendsman and I were talking about back then, I still remember this. Me and him did an interview similar to this one in early 2011, and this is when silver started going parabolic. And I actually remember this. Silver's about 35, right? And I said, look it's going parabolic. It's probably going to pull back to $20 a share or $20 an ounce, thinking that, this 2008 high then becomes the support, right? It blows all the way up to 50. And God, I'm telling you, people were writing us, the silver bugs and the gold bugs. You're idiots. You don't know anything. The silver's never going to pull back. Blah, blah, blah. This is the start of the huge move. And then, of course, it went up a few more months. And then, it actually went down lower than 20. It went to went to $14, $13 an ounce, right? So, that's the whole thing when something's going parabolic or blowing off. And silver, because it's a smaller market, it's more liquid, it's going to have bigger moves than the stock market. But go look at this. Doesn't this kind of remind you of the stock market now, right? We're just going up and straight up every day. And then, you can see that silver really didn't crack to the second half of the year. So that's kind of what I think the stock market's going to do. It's going to peak sometime. You can't time it. Who knows if it's first half or second half, but it's going to peak sometime. Then we'll have a bear market rally, and people probably think it's going to go to new highs again. And then probably the second half of this year into next year, it's really going to fall apart, So that's why I don't chase. I don't care. I've lost enough money in the markets throughout my years that I don't care if I miss that last move of a bubble. You can't time that, And I rather just buy cheap, and sell when it's not, Let's say you bought silver in 2008, right? When it was 8, okay? And then you sold here when it was 30. Okay? You made 4 times on your money. Or say you sold at 25. You made 3 times on your money. Now you missed the last double, but you were perfectly fine with that when silver went back, to 15 or something like that. So I rather buy low, sell medium, and don't even worry about when it goes high,
Well, the biggest thing I learned, or one of the biggest things I've learned from all the years I've been doing this, to escape some of the mistakes that you say, that people learn from, is I think the big mistake that results in other mistakes is being focused on one market with all your money in that one market, because then you lose objectivity and you get caught up in the move. And the way to escape that is to look at multiple markets. So in this video, we're talking about not just the stock market, but gold too. And then we can multiply that out. So someone doing silver, back then, all in silver, the best thing they could have done is look for what about, oil, or what about the general stock market or whatever, right? Not just one thing. That myopic one thing, you get locked into it, and then you can't get out, and then it turns over. You can't believe it, and that's really the mistake people make. So there's people out there 100% invested in the stock market without any gold or gold stocks or other things, and those people will never get out until they can't take it anymore. Just as the silver bear bug bought at $30. And still went up more, but then they never sold. And you know what I'm saying? So.
Well, I'm showing this Russian ETF chart because I want to show people, even these bubbles, you can buy things that are cheap, right? Like by 2014-15, the market in the States is incredibly expensive, and it can stay expensive for years, as we've seen. But Russia was incredibly cheap. And you can see the RSX, which is a Russian ETF, this thing goes to $12 a share, and it's at 21 right now. So if you would have bought that, you're up 70, 80%. Like how many stocks are up 70, 80% in the United States? So if you're patient, this is the junior one, the RSXJ, and you can see this has gone even up better. This has gone up almost tripled in value, right? So what we can see is you're doing this, right? And you're doing this, and what we can see is even in bubble markets, there's going to be markets or stocks that are cheap and you can buy them, and everyone gets obsessed with like, oh, Amazon's gone straight up or Apple's gone straight up, but you can buy something that's beat up for a turnaround play, and actually percentage-wise, it's going to go up even more. But I think one of the problems is, and me and you have had many discussions about this, is that means you have to think, and most people don't want to think. They want to sit there and watch Jim Cramer. They want to think that Apple's going to go up forever and whatever, and that's what they want to do. And they don't want to think, and then every 3 or 4 years get into something cheap, ride that for a few years, and get into the next thing that's cheap, because it actually takes research and homework and thinking, Now, I'm not saying that people listening to that podcast are like this. Actually, you're probably not like that because you are listening to this podcast, but I just think investors as a whole are like this. And this is a perfect example. This is TIO. This was Argentina, Telecom Argentina. This is like kind of my philosophy, that this thing absolutely collapsed. And then you can see you could have bought this at 50 cents in 2002 after the debt crisis in Argentina, and it went back to $20. You made, 40 times on your money, plus there's dividends as well. So that's the kind of stuff I look for. And by the way, one thing that I've done too, and I'm going to do, is I've kind of found a group of 5 or 10, maybe even 12 stocks that have started to come off their highs, but are kind of like where TO was, say, in 2000, that it was, $7, $8 a share. So I think they have to have that final flush out and leg lower. But when that happens, they will, and they'll probably need a bear market for that to happen, but they will be stocks that potentially can go up 10, 20, 30 times. And, it's happened in the past. You can see the telecom. Actually, one stock that it happened to that I recommended was a telecom company in Greece. I recommended this at $1.40. It went under $1, and you can see it rallied back to almost $9 a share. So these are the kind of things that I look for,
Yeah, and that's why, we share ideas. I talk with you all the time, learn from what you're doing, and read your reports myself. And that's what I recommend people do, is take advantage of the special offer that we're running and get your information so they can follow along and get these opportunities too. Because that's really the best way to do the markets, is do it with other people.
Yeah, and I think with the special offer is, I'm going to be very honest here. The couple offers that I've done recently, my own newsletter, I've done with you, they've done really poorly recently. And the reason being is when markets get high, people are too complacent. This is another sign of a top. They just think, I can sit there and own an index fund. I can sit there and I can own Apple. I can own Amazon. I'm never going to lose money in the markets, right? And this is very dangerous. And the reason this is very dangerous is because that usually is when the market tops, right? When nobody cares, people give up on shorting, they give up on stock picking, they think you just can own the market and it's going to go up forever. And as I showed, this is the last thing I say, coming back full circle to the beginning of this podcast, that the S&P or the Dow now look exact opposite. You can see the weekly right here going up straight, basically since the beginning of the year. They now look the exact opposite of, the way they did in 1999, and everyone was scared as hell in 1999. Now everyone is complacent,
Well, and then we'll see how they feel next year.
I'll tell you, if they feel in 18 months, that's, I think it's going to be a whole different ball game, But and the last thing I'll end off, sorry, if you think, Trump's just like Reagan, he's going to cause this big boom. Here's the two problems, okay? Interest rates were 20% back then and starting a multi-year bull market in bonds, multi-decade bull market in bonds. Now we've got interest rates at all-time lows, okay, number one. Number two, right, the stock market as a percentage of GDP was only 30% back then, so a third the size of the economy, very cheap. Now it's 130%. It's 100% more. It's very expensive, one of the most expensive times ever. So the problem is the valuations and there's not the wins at the back of the sales like they were back then,
Yeah, it's interesting times, that's for sure. And they're just going to get more crazy. It's what it feels like, at least.
Yeah, well.
Thanks for taking the time to talk with me, and we'll do more videos as the year goes. But this is the first video like this we've done, I think, since September, October. So
yeah. It's great to do one again.
Yeah, for sure.
I actually had my webcam unplugged out of my computer. So that's and it had been unplugged for months, because usually when I talk to people, whatever. Yeah, that just shows you how long it's been.
Well, we'll see you. It's good talking with you.
Yeah, good talking with you.